All right, let's talk about Tesla. Today, we're going to dive deep into a recent analyst report that looks at the company through a classic value investing lens. So, we're going to push aside the hype, the tech, the cars for a minute, and focus on one simple thing. What do the numbers actually say about that massive price tag?
So the first thing this report throws at us is this monster number, a market capitalization of $1.432 trillion. It's a figure that's honestly hard to wrap your head around, and it really sets the stage for everything else, because a valuation this big has to be justified by something.
And right here, this is the central tension of the entire story. You've got that massive trillion-dollar-plus valuation on one side, and on the other, the company's full-year profit for 2025, which the report pegs at just $3.8 billion. You know, that giant gap between those two numbers, that's the mystery we need to solve.
Which really begs the question, right? With a disconnect that huge between the price of the company and the profit it's making right now, what on earth are investors actually betting on? What are they buying?
Okay, so to figure that out, we've got to start by digging into the most extreme numbers in the report's financial snapshot. These are the real outliers, the figures that kind of define the whole investment story at this moment. First up is the price-to-earnings ratio. And wow, it's sitting at a staggering 398. To put that in plain English, it means that for every single dollar of profit Tesla reported in 2025, the market was willing to pay $398. That is just huge by any traditional standard.
Then you've got this other wild number, the free cash flow yield. It's just 0.4%. Tiny. Think of it this way. If you bought the entire company today, your actual cash return on that investment would be less than 0.5%. That's practically nothing, which tells you investors are betting on some absolutely massive, almost unbelievable growth and cash flow down the road.
So you have these valuation numbers that are just blasting off into space. But here's the kicker. The report points out that the actual business profits, they're moving in the complete opposite direction. The report really nails it with this one line. Profit compression is the story.
And you can see that compression right here in black and white. The company's operating margin, which is a key measure of how profitable its core business is, has just plummeted. According to the report, it fell from almost 17% back in 2022, all the way down to just 4.6% in 2025. This downward slide is what creates so much tension with that sky-high price tag.
And all of this brings us to a really important idea, fragility. When you have shrinking profits colliding with a massive valuation, it creates a pretty fragile situation. You have to start asking, what has to go perfectly right for this stock price to even make sense?
So why should we really care about these crazy numbers? I mean, are they just trivia points? No way. They're basically giant flashing signals of risk and, well, sky-high expectations.
The analyst report actually pulls all of this together into a pretty sobering list of red flags. We've talked about a few already, that extreme valuation, the tiny cash yield, and the profits getting squeezed. But the report also calls out weakening margins in the core car business and, this is a big one, a huge amount of stock-based compensation. Okay, so what is stock-based compensation, or SBC? It's a way companies pay their employees with stock instead of cash. Now, it doesn't use up cash today, but it's a very real expense that dilutes other shareholders. And here's the jaw-dropper from the report. In 2025, that SBC expense was equal to nearly 75% of the company's final reported net income. This chart really drives that point home. I mean, look at this. Of the $3.8 billion in reported profit, a whopping $2.8 billion of that was effectively an expense paid out in stock. So, when you're trying to assess the true quality of a company's earnings, that is a detail you absolutely cannot ignore. Okay, so with all these red flags flying, what would a really disciplined, old-school value investor think? Well, the report does something cool here. It runs Tesla through a classic test. The one created by Benjamin Graham, the guy who literally wrote the book on value investing. And let's give credit where it's due. The company actually passes some of Graham's foundational tests with flying colors. It's certainly big enough. It has a strong current ratio, which is a good sign for short-term financial health, not a lot of long-term debt. And yeah, it has been consistently profitable for the last 5 years covered in the report. But, and this is a huge but, when you get to Graham's rules on valuation, things just go completely off the rails. Graham had this simple rule of thumb. Your PE ratio multiplied by your price-to-book ratio should be less than 22.5. Tesla's number, based on the report's math, almost 7,000.
I mean, it doesn't just fail the test, it completely shatters it.
So that's the thing, right? If the current price makes absolutely no sense based on the past or present, what does it imply about the future? What exactly is the market expecting? The report flips the math around to find out.
And the math is actually pretty straightforward. You start with that massive $1.4 trillion market cap. Then you ask, okay, what if Tesla was just a normal, mature company trading at a more conventional PE ratio, like 15? Well, to make that math work, to justify today's price, Tesla would need to be generating about $95.5 billion in profit every single year.
And this chart just says it all. On the left, you see the actual 2025 profit, $3.8 billion. On the right, you see the $95.5 billion it needs to be making to justify the price at that normal multiple. That gap, that massive chasm between reality and expectation, well, that's the bet. That's what investors are paying for today.
And this quote from the report's conclusion just hits the nail on the head. It says, the investment case isn't really about the car business we see today. It, quote, hinges on future step-change profit pools that are described directionally, but not yet validated in segment economics. In other words, it's a bet on a total transformation, on future profits from AI, software, robotaxis, stuff that's been talked about a lot, but isn't showing up in the numbers. Yet.
So after all that, where does this leave you if you're trying to follow the story? Well, the report wraps up with a really practical watch list, a list of the most important things you should be monitoring yourself.
First, the bottom line from this value investing deep dive. The report's final verdict is speculative and needs caution. And the reasoning is pretty simple. At this price, there's just not much wiggle room if things don't go perfectly. There's a very limited margin of safety, as value investors call it. And if you are watching this story unfold, the report gives you a specific checklist. Keep an eye on that operating margin trend. Is it starting to turn around? How's the free cash flow holding up against all the capital spending? And crucially, are we seeing any real money, any tangible financial progress from those big future bets like full self-driving and the robotaxi network? And that leaves us with the $1 trillion question that this whole analysis has been building towards. When the expectations are this monumental, when the valuation is basically demanding a near-perfect business transformation, you have to ask yourself, is all of that amazing future already priced in?